Well, yes, it's an interesting note actually that in every health crisis, pandemic that we've witnessed in the last 20 years, food prices have seen an increase, and it's logical as well in many ways. A pandemic tends to, of course, disrupt farms, supply chain, and then, of course, not to mention, leads to a lot of people hoarding as well. And even if that does not happen, sentimentally, it does sort of cause a spike in food prices. So that's our special report for today. But let's move on now and talk about buybacks. Over the last 6 odd months, in fact, just in the very recent past and in the upcoming future as well, companies are making a beeline to conduct buybacks. What exactly is a buyback? Well, essentially, it's the company telling its shareholders that you return the share you own of the company and take money instead. Sounds pretty simple, but it may not really be that simple, because the question is, should you tender in your shares to the company? Is the price of the company offering good? Should you compare it with perhaps a book value? And what if maybe a couple of weeks later the price in the share market rallies? That will really give you some FOMO. So let's understand this whole buyback math with Santosh Kumar Singh. He's the head of research with Motilal Oswal Asset Management. Santosh, many thanks for joining us today on the Money Show on ET Now. So to start with, Santosh, we've got IT companies, some of the biggest ones. TCS concluded it, Wipros will start. You've got a lot of PSUs. Some of them will go live in just a couple of days. We are expecting a lot more buybacks as well from PSUs, with the government wanting to shore up money as well. The question, of course, is that when a company does announce that, look, I'm going to be announcing a buyback, or we are going to be holding a board meeting to announce a buyback, the share price usually shoots up. So let's understand why that happens first, Santosh, for our retail investors.
So see, what does a buyback do? It takes away the excess money from the company's balance sheet, and it is returned back to the shareholders. So this cash is as such of no use to the company. That is the excess cash lying in the balance sheet of the company. Now, what it also does is it reduces the number of shares. Okay, which means the earning per share is going to move up. So so it's simple mathematics that if I was making 100 rupee of profit and if I had 100 shares, the EPS is 1 rupee, whereas if the share comes down to almost like 90, then my EPS goes to 1.1. So there is a 10% increase in the value of my shares per share value. Now, if that is the reason why companies are doing buyback, there is a good reason why the stock prices should move up. Another reason why companies do buyback is because they think their share prices are significantly undervalued and they have cash on the balance sheet, which means that they see an opportunity wherein they can reduce the number of shares and increase the promoter holding and the holding of the investors who want to stay invested in the company at a much lower price, increasing the value, the EPS of the investors who will stay in the company. So definitely, if it is the reason is that, then definitely the stock prices are going to go up because the number of shares are reducing, and the charge on the total profits is reducing.
So logically speaking, the company has excess cash in its balance sheet, it's giving it back to shareholders. Further, because now the shareholders will return some of the shares, so the amount of people or the number of shares among whom the profits of a company has to be distributed is lower. So each shareholder will get more profits of the company. So it's a very logical reason why the share price usually rallies. But the question now, of course, comes on whether you should tender in your shares. So like I mentioned, Santosh, we had a couple of tech companies, we have a whole list of PSUs as well that have either already announced a buyback or perhaps will announce a buyback in the weeks or the months to come. As somebody who's got that enormous experience in share markets, in investing, what would be your advice to retail investors that when their company tells them that, look, I'm announcing a buyback and if you would like, you could tender in your shares, what would be the top 3-4 things you would recommend they look at before making a decision?
So see, the selling decision, so buyback is almost like a selling decision, right? So when you're making a selling decision, one should be clear is that the fundamental value of the company at which you are selling it back to the company is actually lower than or is equal to what the company is offering you. If if the fundamental value is significantly higher than the price at which the company is willing to buy back. And generally this is the case, because generally companies want a buyback when they see that their share prices are stressed out, or they are lower because of not so much of demand in the market for their shares. So if that is the case, and if you find that fundamentally the value of the companies is much higher than what the buyback price is, then there is all the reason that one should not give it back to the company. However, at certain points, one of the biggest reason why people just give it back to the company is because the share prices would have not done anything for multiple years or multiple months, and then they are just annoyed with that you know what, everything in the market is moving up, my stock is not moving up, what will I do of the fundamental value? And here is a buyer who is willing to take back my shares at 5% premium to the last price. So this is where the investors' conviction on the stocks are tested. So if you have a conviction that okay, the fundamental value is much higher, one should not give it back. Why one should give it back? So and also the time frame to hold the stock. So if you are willing, if you have a long horizon, means you want that fundamental value to come to you rather than giving it back to the company.
Makes sense. So basically it depends on whether the shareholder believes in this long-term story, or basically in the fundamental value of the share. If he believes that it's going to go up, then obviously don't tender it. But Santosh, many a times, individuals and especially retail investors may not have the wherewithal, the know-how. Many a times it's received, from their father or their grandfather, old shares. How can, what should they look at? Our BSE, NSE, they all have something called as book value that, they print on the exchanges. As an easy way, should individuals look at that to start off with? And, let's talk about PSUs, because we have lots of PSUs now that will be announcing buybacks. Many people are, old shareholders of PSUs. So if you can give an easy way in which they can sort of determine whether, the buyback price is good or not good, for them to tender in, or as you said, sell their shares.
See, book value per share is definitely one of the criteria that if the price being offered is significantly lower than book value, then there is all the reason why the stock is undervalued. But that's one of the ways to look at it. But the other point of view is that if the book value is low but the company is loss-making, then there is no reason to hold the stock. So what one needs to be aware of, that if the book value per share is significantly higher than the stock price, and if the company's ROEs are in the acceptable range, then definitely one should think twice before giving back the shares to the company. So giving back the shares to the company. The other thing one can look at is that if the company is delivering a 10% dividend yield, right, and if the book value per share is significantly higher than the current price, then then logically, in most of the cases, the stock is significantly undervalued. So dividend yield, BVPS, return on equity, these are 2-3 things one can, these are the easier way to look at it, because if you are not going to sort of get into the analytics of the business models or long-term forecasting, then these are the easier things to look at and think about while thinking about a buyback.
All right. So before considering a buyback, look at the other factors: dividend yield, ROE, and I understand one thing, and that's something that Santosh as well said, that companies want buyback when they see share prices are lower. So that as well is something that you must consider, that because the company as well wants a good deal for themselves. They see that the market is not really pricing much for the shares, so they will take the opportunity to sort of buy some of the shares back from the market, from investors like you and me. And sort of give them the cash instead. So that's important as well to understand. Santosh, let's talk about acceptance ratio. How important is that? And if you could just sort of explain that concept as well to our viewers. Santosh, I was just asking you about acceptance ratio, because see, when the company announces a buyback, they obviously are not announcing a buyback for 100%. They also have a limited amount of cash which they will spend. So if I have decided I'm going to tender in my shares, is it necessary that the company will accept my shares for the buyback?
So it depends on what the scheme is. So if the scheme is such that wherein generally what we are looking at in the market is that the offers made by the overall acceptance of the buyback is much lower than what the companies are offering. That's what we've seen in a lot of undervalued stocks. So if that is the case, then all the shares which you are tendering might get accepted. So it depends on what the price which at least they are giving it, the buyback price, how much premium they are giving, what is the size of the buyback. Because if the size of the buyback is say 100 crores, and if 500 crore of shares are being offered to the company, the acceptance ratio will be much lower than what you think. So it's not necessary that whatever shares you are giving back will get accepted.
Okay, all right. Santosh, thank you so much for giving us this ready reckoner of sorts, for shareholders on buybacks. And I guess it's important to get in your take, an expert take on this whole bit, because many a times retail investors are often posed this question that, okay, look, your company is announcing a buyback. Do you want to tender in your shares? And you don't want that whole FOMO feeling, because what if you tender in your shares at a particular price and post that there's been a massive rally in the share price? So that's when, you should always perhaps look at the fundamentals. If you don't want to gauge much into that, you have dividend yields, you have ROEs, all of that can be looked at, and if you're happy with that, then don't tender in your shares. If you think that there is a possibility of obviously the shares rallying much more, don't tender in your shares in the buyback. Thank you, Santosh, for joining in. And on that note, we'll take a very short break on the show. Don't go anywhere.